Hi, and welcome to our end of March update from the Wealthy Doctor Institute. Physicians leading physicians through finance. We work with physicians and other busy professionals who are not happy with their current investment strategy. We help them get this part of their lives handled so they feel empowered and in control. I'm David Ye, and in my book, The Busy Doctor's Investment Guide, I show you just a few ways where just a few adjustments each year can help build and protect wealth. Although the strategies in this book are easy to calculate each month, for those who are new to the concepts of this book, or for those of you who are new to investing in general, this video will try to clarify what I do every month. Feel free to follow along every month until you get the hang of it. So this month, we'll cover the Busy Doctor's update for the month, topic of the month, review our 20-month moving average system, review the MRI system, remind ourselves of the rules for the 25% stop loss system for those of you who really have to invest in a particular stock for some reason, and monitor the free SectorSurfer strategy that comes with your SectorSurfer subscription. So, day in the life of a busy doctor. Even though I semi-retired 5 years ago, life continues to be busy. And part of the perks of being semi-retired is that I still get to be a radiologist and nuclear physician, only without the soul-crushing pressures of call and politics, both internal and external. But yet, sometimes, like in March, when the hospital was short-staffed, they asked for my availability, and when I gave them a list, they took it all. So yes, March was pretty busy for me, just practicing almost like a full-time physician. But still, despite the busyness, I still easily place the trades indicated by my systems. They literally require mere minutes to see and execute. So the topic of this month is the concept of rebalancing and using guardrails. And this topic keeps coming up again and again, and although I addressed this in my book and in previous videos, I feel I need to update my data and just show you what these guardrails and rebalancing really imply. So remember, to rebalance implies that you already have some kind of pie chart. In other words, you have a certain percentage of several different asset classes, and of course, one asset class is always going to do better than the others, and one's going to do worse, and the others are going to do in between. So whatever percentage that you have, they're going to be off balance, and that means you have to sell some of the better performing ones to buy some of the worst performing ones so you can get back to the same balance again. And this all presupposes that there is no way that we can recognize or capitalize on any type of trends in the markets. And since we can't predict the markets, we shouldn't even try. Hence, we rebalance. And it's true that if you try to buy last year's winners, if major trends tend to last 9 to 16 months, if you have a 12-month look-back period, of course, you're probably going to buy the next loser because the major trend has already exhausted. And then, of course, there's a guardrail theory. So when an asset, let's say you have stocks, and let's say you want to make 60% stock and 40% bonds, and stocks went gangbusters and went to 70%. Well, let's say you have 60% but plus minus 10%. So that means if it goes up to 70 or goes down to 50, you automatically rebalance. That's what the guardrails are supposed to say. Some advisors, some investors use more narrow guardrails, but I'm going to show you even with big fat guardrails, the differences aren't really that great. Versus, for instance, routine time-based rebalancing. So instead of waiting for asset class to touch a guardrail and then rebalancing, there are other systems that just balance every quarter or every year. So let's take a look at the differences. So here's an example pie chart that I like to use as an example. There are many pie charts out there, many from so-called reputable sources. I like to use this one just because this one comes from a best-selling book that's pretty familiar to most of the people who get my videos. It's from Tony Robbins' Money Master the Game. In fact, it's the David Swensen pie chart. For those of you who don't know, Swensen is a legendary money manager who has produced 14% per year on average for Yale's endowment fund for over 20 years. It's He's a legend among money managers, at least in the university field. And this is the particular pie chart that he recommends to his own family. So 20% in total stock market, 20% real estate, total 20% in international stock market, 10% emerging markets, 15% bonds, 15% tips. So buy, hold, and rebalance. Well, let's see what happens when we buy, hold, and rebalance. So this graph shows the performance of the 6 components of the pie charts. I use the ticker symbols here just to make things a little bit more abbreviated, to make things fit. But you can see how real estate looks like it's taken off, but it's really volatile. It goes up and down a lot more than, for instance, even stocks. And bonds are much smoother. So here are the components again, only this thick dark red line represents what happens if you were to just buy the pie chart way back in June of 1996 and you just held on, reinvesting dividends and capital gains, but otherwise not rebalancing. You just bought, held, and prayed, literally, or put on a lockbox and not even look at it for another 21 years. Versus the heavy blue line here where we rebalance every quarter. So this is the reason why we rebalance. For years, there may not be a difference, but maybe 1 or 2 years, there may be a significant difference where if we balance, you can eke out maybe 0.5% more per year on average. And what does that look like? So for almost 22 years, the total stock market returned 8.56, real estate 9.76%, international stocks 5.19, blah, blah, blah. If you buy, hold, and rebalance every quarter, you get 8.08%. So it's true that you never do as badly or worse than the worst fund. But it's also true you never do as well or better than the best fund. By definition, you're doing average. You're averaging away the risk, but you're also averaging away the returns. All right, well, how is this compared to just buy, hold, and pray? If you bought, held, and pray without rebalancing, you get 7.47%. So there's where you get that 0.6% difference by doing something a little bit more active than just buying, holding, and praying. And by the way, when money managers charge an average of 1.5% per year just to do this for you, it's a hard sell to convince you that whatever they're doing actually makes such a difference that it would improve what you could have done by yourself just buying, holding, and doing nothing. Having said that, now let's look at what happens when we use guardrails. So let's take a look at 2 extreme cases. Let's say we overweight stocks. In other words, let's become a death wish daredevil with aggressive 90% stock, 10% bond portfolio. And we were to rebalance this every quarter. Versus if we were to underweight stock and we become Mickey Mouse conservative with 50% stock, 50% bonds. So here's how the extremes compare. Same 6 asset classes. Originally we had 20% stock, real estate, international stock, 10% emerging markets, 15% bonds and tips. If we were to overweight stocks, in other words the top 4, we'd go from 20 to 25%. Total stock, real estate, and international stock go from 10 to 15%. Emerging markets, together that's 90%, compared to only 10% bonds. Versus underweight, 15% total stock, real estate, international stock, emerging markets. So again, we're going down from 20% to 15%, these 3, and the emerging markets going down from 10% to 5%. And we're making up with bonds 50% total portfolio. Let's see how it works. So here are the pie chart components. I left in the total stock market for reference. I left in the long-term treasury bonds for reference. And here's this dark red line for buy, hold, pray, don't rebalance. And we take a look. If you had the rebalance, overweight stocks, underweight stocks, they're virtually the same curve. All right, now this green line, yes, when the stock market falls, you fall a little bit more, yes. And when the stock market rises, yeah, you rise a little bit more. But in the grand scheme of things, it doesn't really make that heck of a difference. Yes, sometimes you drop more and sometimes you gain more, but on average, you'd be hard-pressed to tell me that there's really that much of a change. So let's look at the numbers. Comparing the extremes, the original pie chart versus overweight stock versus underweight stock, the compound annual growth rate over those almost 22 years, I have to go 3 decimal points just to detect what differences we have. So originally we get maybe 8.076% annualized return versus 0.003 more for overweight versus 0.003 less for underweight stock. Now let's translate into something a little bit more tangible. Let's say we invested $1,000 almost 22 years ago. If we invested in that standard portfolio, we would have made $5,420.17. We would have made $4,420.17 on top of our $1,000. If we were to go into an aggressive portfolio, we would have made a little bit more than $3 more over 21 years. If we were to become more conservative, we would have made maybe $3 less over 21 years on that same $1,000. So you're making less than 1% more for going way aggressive and making less than 1% less by going way conservative. And all this fuss about how to become more aggressive or conservative, I have to laugh. But wait. We showed that the aggressive portfolio was really more volatile, right? I mean, it fell more when the stock market fell and it rose more when the stock market went up. All right, well, let's take a look. So these minor wiggles in the grand scheme of things, during the big stock market crash from 2000 to 2002, stock market lost 39.4%. If you were in tech stocks, you lost more. But in general, the total stock market lost 39.4%. Now, the pie chart portfolio lost 7.7%. All right, so it lost less here. But look at 2007 to 2009. The stock market lost 45.8%. Our portfolio lost 36.6%. Now, granted, it's less loss, but still, to lose 36%, you have to make 51% just to break even. You can tell me, all right, fine. If you lose 45%, you have to make 84% just to break even. So yes, it's harder to break even if you are on stocks. But my contention is, if this investing strategy is supposed to be so safe, I don't consider a 36% loss safe. So let's talk about rotation versus rebalancing. Rotation might be a new word for some of you. I've been talking about this every video so far. I've described it in my book. If you talk to me, you know I talk about rotation all the time. What gets me is that you read any other book about investing, they all diss rotation. Problem is, if you look at the fine print, they always look at, well, if interest rates are going up, then the sector rotators will sell bonds and buy stock, because everyone knows that rising interest rates means bonds will fall and stocks will rise, and of course that doesn't work. So the pie chart rebalancers say, sector rotation doesn't work. However, no one ever mentions mechanical rotation, and here's what I mean. I've described one version in my book, and everyone who follows these videos knows that I now use SectorSurfer. If you were to mechanically rotate with a signal that tends to come at the end of the month, and all we did was hold the strongest momentum fund at any one time and hold for at least a month, rotating maybe 2.5 times per year on average, we would get this teal line. Now, this teal line outperforms on average the stock market and the pie chart so much that it looks very impressive. And that's because when you have compound growth, the farther along you go, the more impressive it looks. Likewise, someone is going to look at 2014, 2015 and go, holy cow, there was this huge drop in the markets with the sector rotation as well. Well, remember, the higher you go, the larger the changes look. So to wrap our heads around larger numbers, let's switch over to a logarithmic graph. So for people who are not familiar with logarithmic graphs, think about it this way. From 1 to 10 is one unit on the graph. From 10 to 100 is another unit. So over here, the top is around 18, 8 difference here, 10 difference here. With this kind of graph, it's a lot easier to see what percentage changes are happening in our various strategies. So yes, in 2007 to 2009, when the markets were dropping 45% and the pie charts were dropping 36%, this system only dropped 9%. And we take a look at these wiggles, these are maybe 10% wiggles at the most so far. Again, past performance doesn't guarantee any future results. I'm supposed to say that. But at least in the past, using this algorithm, we would have been able to severely mitigate risk. And when you hear interesting sounding theories, but you don't backtest them, you don't know where their weaknesses are. And for people who say that, oh, pie chart diversify and rebalance is such a great thing, conservative versus aggressive portfolios, such a great thing, and now I've just debunked that with a simple backtest, how likely do you think an aggressive portfolio will fare in the future compared to a conservative portfolio versus a rotation portfolio? So, as I said, I use rotation using SectorSurfer, so here's a SectorSurfer graph. And for those who are a little bit more geeky, who can take more data, who actually love looking at data like this, like I do, I've explained some of these parameters and indicators in the past. For those of you who like to look at this data, go ahead and pause this video. I'm just go ahead for those people who eyes glaze over looking at things like this. So remember, there's rotation, plus we can also add in a bear market filter to use only stock funds to optimize when it's relatively safe to be in the markets, and then rotate only through bond funds when it's relatively dangerous to be in markets. And this way, we mitigate the downside during bear markets even more. And again, here are all the bells and whistles for people who like to look at this. And going on, let's review our systems. First system is the 20-month simple moving average system, what I call the 20-month SMA system. The rules are simple. If the price of the S&P 500 index fund is above the 20-month moving average, it's relatively safe to stay invested in the index fund, otherwise get out. Remember, the 20-month moving average is our safety belt. It only works if you watch it every month. Not more than a month, but not less than a month either. So here's a graphical representation of where we are right now. So at the end of March, the VFI Next, which is the Vanguard S&P 500 index fund that I use to calculate at the end of March, was $243.81 per share. The red line, the moving average, was increasing to $222.97. So even though the index fell, the moving average still increased, because remember, it's the average price of last 20 months. And so now, divide, we have a 9.3% cushion. In other words, if the stock market drops less than 9.3% during the next month, we're relatively safe. But don't jump the gun. Let the markets tell us what to do, and we'll find out next month whether or not we need to do anything. So the observations for this month: the SMA indicator continues to signal relative safety in the US stock market. Even though the market itself fell, the moving average continues to increase, so that the cushion is now decreased to 9.3%. Remember, we're not trying to catch the peaks. We're just trying to see whether or not it's relatively safe or dangerous to be in the markets. And until it meets criteria for danger zone, it's still, by this system, relatively safe to be in the markets. No system is perfect. If we've been losing money for the last 2 months because the markets have just been screaming ahead for the last year, it may just be part of the wiggle that is expected when markets go up. Again, we'll see next month whether or not we need to make any changes. So here's SectorSurfer's Stormguard Armor. For Stormguard Armor, we've also been in stocks. So the indicator says that we're still relatively safe in the bull market territory. Although it's getting closer and closer to bear market territory, it's still in a relatively safe zone. Next system is the Monthly Rotation Investment System, abbreviated to MRI system. The rules are simple. You only have 3 mutual funds to monitor: the S&P 500 Index Fund, the Emerging Markets Fund, and the inverse S&P 5 Index Fund. Every month, rank these three funds dividend-corrected data, sell the bottom 25% of your portfolio, and buy the top fund. So here's what it looks like this month. Last month's data, this month's data. Subtract, divide. We see that the S&P 5 Index has lost 3% this month so far. The emerging markets lost 1.3%, and of course the inverse fund goes up because by definition one of these is going up. So you can see the markets have been pretty flat for most of the month until on the 21st. If you remember, that's when the Federal Reserve announced, oh my god, they're going to increase interest rates. So did stocks go up because we're going up in interest rates? No, actually went down. And did bonds go down? No, actually bonds went up. So this is why I don't look at secondary data to make these calculations. The markets can stay irrational longer than you can stay solvent. So let the markets tell us what to do. Every single trade in the market leaves a footprint in the stock market charts. Charts don't lie. Trying to figure out what they're saying may be tricky, and that's why we use our mathematical algorithms to help interpret the market data without getting caught up in our own emotions. No system is perfect, but our own emotions mean certain death in the markets. So here's our current MRI model. Last month we were roughly 1/4 in the inverse fund and 3/4 in the emerging markets. This month we're supposed to sell 25% of our losers, and that's our emerging markets, and buy the top fund, which is the inverse fund. So now we're roughly 50% inverse fund, emerging markets fund. And here's the SectorSurfer version of the MRI, using the same three funds, rotating without using StormGuard. You can see that we're still in the emerging markets. That means SectorSurfer has not yet met criteria to switch to any other fund yet. Now we just have to watch next month. So observations of this month. The markets were relatively flat until March 21, when the Fed announced an increase in interest rates. And then the markets do what they always do. They go against the most popular interpretation. Meanwhile, the emerging markets again outperformed the large cap US stocks by losing less than the US stocks. But since both the emerging market and the US stock markets lost money, the inverse fund gained. By definition, something is always gaining. And this is the second month in a row that the inverse fund is gaining. Does that mean that a bear market has developed yet? Still a little bit too early to tell. Again, let the markets come to us. And SectorSurfer continues to be in the emerging markets. Again, SectorSurfer uses a different algorithm. Don't mix up the systems. Next system is a 25% trailing stop loss system. This system is used to invest in an individual stock if for some reason you really want to buy an individual stock instead of a fund or an ETF. And that's because single stocks themselves have increased risk. If bad stock-specific news comes out overnight, that one stock could tank even though the rest of the sector is still doing fine. So, if you really want to buy an individual stock, you don't want to risk more than 1% of your portfolio on any one stock. So, if you have a 25% trailing stop loss order, you can use up to 4% of your trading capital to buy that one stock and make sure you put it stop 25% below that stock price. And as the stock price goes up, keep ratcheting up your stop loss until finally, when the price of the stock goes up 33%, your stop loss is now at break-even. Since now at break-even your risk is essentially zero, you can go ahead and use another 4% of your account to buy another block of stock. And just be sure you update your trailing stop loss order to reflect the increased number of shares. And keep repeating until stopped out. Next system, for some of you, you've opened up your own SectorSurfer accounts. Now, when you look at their disclaimers, I'm not allowed to recommend anything. I'm just telling you that this is what I use, and for those of you who use SectorSurfer, here's how it works. It has two main tools. You have the StormGuard Armor, which is SectorSurfer's way of figuring out whether or not it's relatively safe or dangerous to be in stock market in general. It's not foolproof, but it's better than what I describe in my book. And you have sector rotation, which tries to pick the best fund or ETF based on whether or not it's a bull or bear market. So you'll rotate only through stock ETFs if you set up correctly when it's relatively safe to be in stock market, and then rotate only through bond funds or inverse funds or some other non-stock fund when SectorSurfer says that it's relatively dangerous to be in stock market. So with SectorSurfer, if you set up properly, you will get a signal either through text or email or both, depending on how you set it up. When you get a signal, you log in just to see what kind of trade you're supposed to make. You make that trade, you click on acknowledge, and it turns into a big green done button until the next signal. Me, I like to log in periodically, at least once a week, just to make sure I don't miss any signals. All those signals are typically generated at the end of month. Sometimes StormGuard Armor kicks in mid-month. And when you sign up for SectorSurfer, it gives you a free strategy. It's not the best strategy. If you've been listening to my videos, you know several ways of improving that free strategy they give you. However, it's a free strategy. You can feel free to use it if you want, and because it's free, I get to share how it's doing with my videos without making it unfair for any subscribers. So for the free strategy this month, it remains in a safe for stock zone and no trade indicated. Remember last month, a trade was indicated. This month, we're still in the Fidelity Worldwide Fund. So here it is. If you look at SectorSurfer, you'll see this chart. If you get dazzled by all these bells and whistles, just know that right now we're still in the Fidelity Worldwide Fund. So what have we talked about in this video so far? Topic of the month was this whole thing about rebalance with guardrails. I just showed you how even between super aggressive and super conservative portfolios, when you rebalance diligently, either using a time-based system or using guardrail system, for all practical purposes, there's very little difference. And if you're going to take periodic actions anyway, consider rotation instead of rebalancing. Then we reviewed our systems, including our 20-month moving average system, the monthly rotation investment system, dealing with stock tips using our 25% stop loss system, and the sample-free SectorSurfer strategy when we talk about SectorSurfer. So keep those questions coming. I know I talk to several of you every month. Some of you use SectorSurfer, some of you have your own investment systems, and you're happy with your investment systems. Great. I'm not worried about you. But some of you, oh my God, especially if you're still unhappy with your current investment strategy or lack of investment strategy, definitely schedule a time to talk to me. I used to think I was pushy or salesy when I offered to talk to people, but really, I mean, I've witnessed so many people change their lives just from my talk. I now feel that it's a disservice if I don't let you know that, look, help is right around the corner. And if anything, if all you can do is, from our talk, get a sense of clarity about the financial future you really want, that's a huge sticking point with a lot of people. If you don't know what you really want and you're not clear about it, then it doesn't matter what kind of investment strategy you use. If you don't know where you're going, then you're likely going in circles. And then once you establish that clarity, if we can figure out the essential investing building blocks for your particular situation. I mean, I talk about several different things in my videos. Some people just need one thing and the whole trajectory in life changes. And then even for people who know what they should do, determine what stopped you from getting what you wanted in the past. That's also huge. And once you know that and know what actions you can take right now to go forward, I mean, some people wait until all the green lights are green before taking off, but sometimes just taking that first step makes a huge difference. Just taking these steps, and if you don't know your steps, there are resources out there. And after our talk, we'll complete the consultation with the excitement of knowing exactly what to do next to sculpt your financial future the way you want it to be. No system's perfect, no situation's perfect, but there's always room for improvement. Think of this like CME, only it's for personal financial reasons. And even if you felt financially well, if you had a financial cancer or blind spot that you didn't know about, wouldn't you rather at least know? so you can deal with it before the problem grows and metastasizes? Don't be bashful reaching out. The more you delay, the more time is against you. So, until next month, invest safely.